China in a very quick time became the biggest US creditor. At what price? Which price US will have to pay for it?
Well, I mean, the United States will have to. It's hard to say. I mean, in general, I don't think this situation is unstable unless somebody makes a mistake, right? Now, what would a mistake be? Well, a mistake on China's part would be to dump the United States treasuries quickly, because if they did that, first of all, they'd probably lose a lot of money, but more important than that, they'd drive the exchange rate up relative to the dollar. That would make them less trade competitive. So, in some funny sense, the interests are sort of aligned. A mistake on the United States' part would be to become extremely protectionist. Because if we closed our market substantially to Chinese goods, then they don't care what the relative price of their currency is relative to ours, because they're not trading with us anymore. And this isn't going to happen, but you see the point. So I expect China over time to sort of unwind their investment in the United States, but very slowly. And that's consistent with their policy of gradually letting their currency appreciate. I'll show you that in a second. Now, when the crisis struck, China stopped the appreciation and just have held essentially flat against the dollar. What most people don't realize is they've appreciated against almost everybody else. Holding flat against the dollar means appreciating against the pound, against every developing country's currency, all of which have gone down. And so,
always buying treasury bills.
Yeah, basically, they have complete control of the exchange rates vis-a-vis anybody else because of the reserve, so they can set it anywhere they want, subject to kind of political pressure. And so when they decide they're going to sort of stop the appreciation, they just buy a little more of the foreign currency, in this case dollar-denominated assets. And the other thing is not well known, so I might as well tell you. I mean, most people think that the reserves come from trade surpluses. Actually, some of them do, but most of it comes from, I don't know how much, kind of international accounting but basically, for any country, the surplus or deficit on current account is matched by the surplus or deficit on the capital account. But in China's case, they run a surplus on the current account, which used to be fairly small in percentage of GDP terms, and then ballooned starting in 2005. I mean, really ballooned. So it went to 12% of GDP in 2007. That's a big number. But on the capital account, the private capital account was also positive. Why? Because there were huge investment opportunities. There were capital controls. Money was trying to get by the capital controls. And so there's China sitting there with a growing trade surplus and a whole bunch of capital trying to come in, and the combination will drive their exchange rate up. And they said no. And so what happens is the central bank takes the dollars that come in. They come into a bank. The bank gives them to the central bank in return for currency. That could be inflationary, so they have to undo that effect. And then they take them and buy treasury bills. So what's happening is the money is circulating. Okay, the dollars are circulating from American investors into China through the Chinese banking system to the central bank and back to the United States Treasury. And then those are treasury bills that Americans don't have to buy, so they take the money invested in China. I mean, this is a little overly simple, but basically what China was doing was outsourcing part of their capital allocation system to us. So the money just goes around in a circle, and that can happen even if there's no trade surplus. Okay, there's zero trade surplus, but the private capital is trying to get in, and so back it comes around, and that's a fair amount of the reserve accumulation, and it comes from the policy of being unwilling to let the global capital markets decide what your exchange rate is going to be, because your exchange rate is essentially the terms in which you trade with the rest of the world. Put slightly more technically, the exchange rate is the relative price of tradables and non-tradables. And China's not willing to do that. Neither is any other developing country of any significance. They all manage the currency in some way or other. It's just China's is particularly strikingly, because it was pegged until 2005. So that's what's going on. So I think China will resume a gradual appreciation for two reasons. One, it makes sense externally, but they also are trying to keep up the pressure to change their economy structurally. See, if China sits on the exchange rate for too long, they'll lock the economy into labor-intensive manufacturing. But in fact, with the incomes rising, they're going to get out of labor-intensive manufacturing. You can't have per capita incomes of almost $3,000 and be the low labor cost country, right? So they're about to enter that transition. As they get further into it, it'll be the middle income countries. It's a very complicated thing to manage, but that's what they're doing, and they know it. They're bright and smart, and so they won't do it too fast, and they won't turn it over to you and me and everybody else who buys and sells currency, but they'll keep this upward steady pressure on the economy to change itself to essentially, in the end, a modern economy. As they do that, they will exit the things they've been hyper-competitive in, and that will leave room for other people to enter those areas.
How long will it take for you?
Well, think about it this way: if China can grow for another 15 years at 10%, it'll double 2 more times. That'll take it to $14,000, and it's getting near the low end of the advanced country levels. And after that, they'll probably have to slow down because you can't grow at those speeds if you're a high middle income or advanced country. Just the reasons for that. The reason a developing country can grow at these speeds is because it's catching up. It's importing a lot of knowledge, basically, and using it well. After a while, you've sort of caught up. And so the growth that's associated with catching up sort of tends to start declining and go away. And so they'll slow down a bit, but once they're at $14,000, they only have to double one more time. And then they're right in the middle of the advanced country income level. So you can think of China as somewhere between, I would guess, they're a quarter century away of being at OECD type, levels. Much closer in terms of total size of the economy, because there's 4 times as many people. So they'll get to be the size of the EU and the United States about 15 years before they catch up in terms of inequalities. Maybe more, 15 to 20. So those are the time horizons. The rest of these folks are behind. India at sort of 9+% growth is about 13 years behind China. If you just look at a graph. If you just literally put them both on the same graph and then backtrack from sort of, I don't know how to say it. So here's India going along like this, and China's like this, right? If you take where India is and go back until you hit China, it's about 13 years ago. If India then follows the growth path, they'll follow exactly the same path as China goes on. Between them, they're probably now $5 trillion of GDP. That's at current exchange rates. So if these currencies are going to appreciate, then at current exchange rates, their growth measured in euros or dollars will actually be higher than what we're talking about. If you did their incomes in purchasing power parity terms, which is a kind of crude way of sort of, making the exchange rate adjustment, in China, depends on the region, but on average you'd have to multiply the current number by a factor between 3 and 4. Say 3 now. So that the 3,500 is more true in Shanghai than some other parts of the country.